So there is a company which manufactures a single product whose selling price is 40, fixed cost given is 60,000, and then PV ratio. Another way they have used is contribution to sales ratio, which is also known. However, some people may not have heard this word, so I'm stressing on it, which is 40%. They are asking us to find out break-even point in units. Now, break-even point in value will be how much fixed cost divided by PV ratio. So fixed cost is 60,000 and divided by 40%, I will get my break-even point in value, which is 1,50,000. Now I got my break-even point in terms of sales. In terms of sales is 1,50,000. So 1,50,000 divided by rupees 40 will allows me to get the answer of 3,750 units. So the correct option is answer 3,750 units. There is another way of doing it. I know that my selling price is 40, PV ratio is 40%. So 40 into 40%, it will be 16 rupees. So 60,000 divided by 16, you will get the same answer of 3,750. Both ways you can do, whichever is comfortable for you. Moving to the next MCQ, the break-even point of the company, manufacturing company, is 1,60,000. It is given. Fixed cost is 48,000. Variable cost given is 12 per unit. They are asking us to find out the PV ratio. We know that at break-even point, the fixed cost will be equal to the contribution. The reason is there is no profit. So my fixed cost will itself become my contribution. If that is true, the contribution will be 48,000. Now the PV ratio will be what? Contribution divided by 1,60,000 into 100. So my answer is 30%. So option C is the correct answer. Moving to the next MCQ. Here the information given is the PV ratio of the company is 40%. Fixed cost given is rupees 60,000. Desired profit is 15,000. They are asking us to find out the sales. So we know that fixed cost plus desired profit divided by PV ratio gives me the sales in value, desired sales. So 60,000 plus 15,000 divided by 40%. Further simplifying it, 75,000 divided by 40% will give me rupees 1,87,500 as sales figure. So which is your option number C in this MCQ. Next MCQ. So little detailed one. I have prepared summarized information. Please mark it as important. Very tricky, little bit tricky, but it's good question. It can come. Or similar model can come. They are given that variable cost is rupees 15 lakh at the current scenario, and fixed cost the company incurs is 40 lakh in the current scenario. So total cost for manufacturing whatever the units the company is manufacturing, it is 55 lakhs. Now what they have asked in the question is, if the company is not manufacturing this output, rather they are buying it from the outside supplier, whatever the time and resources which the company is spending for the current manufacturing of the output can be used for manufacturing some other output which will fetch the company 25 lakh rupees. So they are asking us to find out what should be the maximum price the company will be ready to pay to the supplier is the question. I hope the question is clear. Now, we know that if we apply the formula, we can find out maximum price, transfer price, or make maximum price which the company will be ready to pay is variable cost plus opportunity cost. Now, I will explain that in detail. Now, fixed cost here we will not consider. The reason is it is already incurred. Now, one more thing, please understand. Just because I'm buying the now further, I'm buying the material finished output from the supplier itself, doesn't release my fixed cost which I have incurred. So let it be machine, rent, everything, because it will remain because I am continuing to manufacture some other product. So there is no savings in fixed cost just from opting from my decision of manufacturing to purchasing. So hence fixed cost is ignored here. Okay. Now variable cost is 15 lakh. Opportunity cost, that is we say that as opportunity cost, which is 25 lakhs. So maximum the price which the company can bear to pay or to get the material from the supplier is 15 lakh plus 25 lakh, it is 40 lakh. So answer is option A, 40 lakh. Moving on to the next MCQ. Given information, they have mentioned that in my godown there is certain obsolete goods which is lying, which is costing to rupees 50,000. These can be reworked by incurring rupees additional 20,000 rupees, and it can be sold thereafter for 36,000 rupees. If I am not planning to rework it, and current status I can dispose it of if somebody comes for rupees 6,000. They are asking us to find out if I am going for the rework, what will be my opportunity cost? So answer is very simple. If I'm going to the rework, so what I'm not going to get, that is the opportunity which I sacrifice, is the current price which I could get from the markets, which is given is rupees 6,000. So the correct answer is rupees 6,000, option B. Next MCQ. In this MCQ, they have given us 2 years sales data and 2 years profit data, and they are asking us to find out the PV ratio. It is simple, straightforward question. There is one formula for PV ratio, which is change in profit divided by change in sales into 100. So applying that, change in profit is 25,000 minus 20,000 divided by change in sales will be 1,70,000 minus 1,50,000. So 5,000 divided by 20,000. The correct answer is 25%. So option is option C here. Moving on to the next MCQ, this is regarding transfer pricing. Interesting question. So it is also important one, you can mark it as important. Okay, so there are two divisions, division P and division Q. Now they have given us the information for both the departments, but both the divisions, and they are asking us to calculate what should be the transfer price for the division P. So for us, what is relevant is only in this question is only division P details. So I have extracted division P details separately. So division P as of now is currently able to generate 6,000 units of output. To the variable cost to manufacture, that is rupees 100 per unit. The fixed cost which division P incur is 1,20,000, and the profit which the company wants to set for the division P is rupees 13,000. Now, what is asked is, after considering all this information, they are asking what should be the transfer price for division P. Now, see here, we know that contribution is equal to fixed cost plus profit. So, in this question, 1,50,000 will be 1,20,000 plus 1,30,000. 1,20,000 is given, 30,000 is given. So, my contribution will be what? 1,50,000. Now, how many units has been division P is producing? 6,000 units. The contribution per unit contribution which the company earns from this is to 1,50,000, and the contribution per unit which the company expects will be how much? 1,50,000 divided by 6,000, it will be rupees 25. Apart from this, company would definitely like to, or the division P would definitely like to recover its variable cost, which is given the question, which is rupees 100. So the transfer price which the division P will be ready or the effective transfer price will be 100 plus 25, 125. The correct answer is option B, 125. Next question. It is regarding the return on investment. Now here, fixed asset is given 8 lakh for a particular division. Current asset is given, it is 5 lakh. Debtors is given 2 lakh. So adding everything, I get total asset is 15 lakh. Now we are assuming here the total asset will be the total capital employed, assuming that there are no other liabilities. So total asset is 15 lakh. From this, the return on investment the company expects is 28%. So 15 lakh into 28% is what my minimum expected return. Fixed cost is given, which is 8 lakh, and variable cost per unit is 10. They are asking us to find out the transfer price of division X. Now, I told you return of income will be 15 lakh into 28%, which is 4,20,000. Fixed cost is given the question 8 lakh. So the contribution is 12,20,000, which is desired contribution. Now, budgeted units which the company plan to produce is 4 lakh. So desired contribution per unit will be 12,20,000 divided by 4 lakh, which will be your 3.05. Plus, company will definitely like to recover its variable cost per unit, which is given the question as rupees 10. So total transfer price, minimum transfer price should be 10 plus 3.05, 13.05. So correct answer is option A. Moving to the next MCQ, similar line question. So I'm not wasting much time. Fixed cost given here is 5 lakh, current assets is 3 lakh, debtors is 2 lakh. So total asset will become 10 lakh. Return of investment is given 28%. Fixed cost is 8 lakh. Variable cost per unit is 10. Variable cost per unit is rupees 10. They are asking us to find out the transfer price. Similar line questions, so we are doing it quickly, moving ahead. So return of investment will be 10 lakh into 28%, 2 lakh 80,000. Fixed cost will be 8 lakh, and then contribution will be 10 lakh 80,000, total of everything both. Now units, the company budgeted is 4 lakh. So contribution per unit will be 10 lakh 80,000 divided by 4 lakh, it will be 2.70. Company should recover its variable cost per rate, which is 10 rupees. So the expected transfer price is 12.7. So correct option is option A, 12.7. Now, next question is based on return on investment. Return on investment is operating income divided by assets into 100. Now, they have mentioned operating income as 55,000 and assets is 2,25,000. So, return on investment is 24.4%. So, correct option is option A. Next question is based on residual income. Residual income will be net income minus capital employed into cost of capital. Now, net income is given the question, which is 1,60,000. Capital we are assuming to be 8 lakh because question is given the net assets as 8 lakh. So 8 lakh into 12%. So 1,60,000 minus 96,000, it will come to 64,000. So the extra income which I have earned is 64,000. So correct option is option C, 64,000. Next question is based on EVA. Economic value added is equal to net operating profit after tax minus amount invested into cost of capital. So given the information that is capital invested is 2 lakh, operating profit is 28,000 and expected cost of capital is 10%. Substituting it, we can find out EVA. EVA will be 28,000 minus 28,000. So it will be 8,000. So correct answer is option C. Moving on to the next MCQ. Here they are asking us to find out EBIT. Please mark this as important because here it involves little application. So mark it as important questions. So we know the particular format is EBIT, my earning before interest and tax minus interest gives me earning before tax. From that, if I deduct tax, I will get earning after tax. Okay. So in this question, the tax rate is 30%. Also, they have given us earning after tax, which is net profit to be 15 lakh. Okay. So if 15 lakh is my net profit after tax, which happens to be 70 percentage, it means what? Earning before tax, if I am assuming to be 100 percentage, so from that the 30 percentage tax will be paid, the balance 70 percent will be my earning after tax. So which is given as 15 lakh. So I can straight away find out earning before tax if I want by doing 15 lakh divided by 70 percentage. Now to find out the tax element, just multiply it by 30 percentage thereafter, which is 15 lakh divided by 70 percentage into 30 percentage. So it will give you 6 lakh 43,000. Now, if I add 15 lakh plus 6 lakh 43,000, I will get earning before tax, which is 21 lakh 43,000. Interest is straight away given the question, it is 10 lakh. So earning before interest and tax will be how much? 21 lakh 43,000 plus 10 lakh 31 lakh 43,000. So correct answer is option D, 31 lakh 43,000. Now, next MCQ, interesting MCQ. They are talking about what is the cost of a responsibility center. It is based on responsibility accounting chapter. An interesting question that may come into the exam. Given information is a department X is there. Department X is incurring indirect material cost, which is 10,000. Indirect labor it is 900. Overtime it is 100. Depreciation on equipment is 500, and allocated factory overhead of department X will be 4,300. Similarly, allocated repair shop overhead is 1,200. From this, what is the total cost of department X as a responsibility center is the question. So here, how we have to start thinking is, what is the responsibility and the power of the department X, and what are the expenditure only related to it, which they can control or they have control over it. That is what we need to take into consideration. So here, indirect material, definitely it is in there within the control, 1,000 rupees. Indirect labor also in their control. Overtime charges was always there in their control. Now apart from that, next is depreciation on equipment. Depreciation on equipment is not in their hands. Reason is we can say a part is fine, because how much they use, accordingly depreciation will come. But there is some other element also, which is what passage of time, because of which are depreciation. So it is not fully in their control, hence it has to be ignored. Next, allocated factory overhead. It means what? 30% of factory space. So the department X consumes 30% of factory space, irrespective of their volume of work. This cost will be there. So again, it is not in their control. So 4,300 shall be ignored. Then overhead of the repair shop is 1,200. Here, what we need to understand here is repair shop is a service department, and the share of the repair shop's expenditure 1,200 is allocated to department X. Why it would have been allocated? Because that much department X would have consumed the services of repair shop. So hence it shall be taken into consideration. So totaling all these things, I will get my share of responsibility sender's cost, which will be 3,200. Hence option A is the correct answer.